Hi, everyone. Thanks for joining us. This is John Nelson with Baker Botts, and we are presenting a webinar on qualified opportunity zones, provide an overview of the opportunities and challenges. That's me in the upper right. I'm joined by Don Lonzak in our DC office, Steve Marcus in our Dallas office, and David Morris from Palo Alto. The CLE Credit Code will be announced at the end of the presentation. If you download the form was provided as a download in the reminder email sent to you yesterday. If you don't have it, please feel free to email Megan, and we have the email address there for you. So it's a robust table of contents here, but in general, our hope is to provide an overview of the opportunity zone regime, detailed requirements for it, and considerations applicable to various investor bases. And so we all know the 2017 TCJA created these new incentives for investments in qualified opportunity zones through qualified opportunity funds. We refer to the zones as QOZs and the funds as QOFs. Just a warning, there's lots of fun defined terms, and we're going to walk through them in detail. And we recognize that there's a lot of definitions out there to keep track of. So the QOZ regime itself is intended to spur long-term investment in low-income communities and are attractive to a variety of investor bases, including those in real estate and technology and oil and gas areas. So the IRS first proposed regulations in October of 2018, providing some guidance. They issued a second set of regs in April of this year, which provided a lot more detailed guidance. Together, the taxpayers can generally rely on those regulations before they're finalized. If they do so consistently and in their entirety, there's some key provisions, though, that taxpayers can't yet rely on to be aware of. One big one would be that a QOF partnership or QOF S corporation, we'll discuss those terms later, selling assets without triggering gain until the regs are final. It's something to keep in mind, and we'll talk about that in a few slides. But otherwise, we assume that the proposed regs will be finalized as drafted. So the QOZ regime provides three main tax incentives. The first would be that up until December 31st, 2026, you can defer gains subject to inclusion events, and we'll talk about those later in the presentation. So generally, you can defer your inclusion in gross income for your qualified capital gains to the extent you invest in a QOF. We call that a QOF interest within 180 days of realizing those gains. And so this incentive we call QOZ Deferral. Qualified capital gains for this purpose include either short-term or long-term gains that would otherwise be recognized before 2027. The second proposed regulations that were issued in April clarify that net 1231 gains are eligible for QOZ deferral. At 10,000-foot level, net 1231 gains are net gains over losses from the sale or other taxable disposition of property used in a trade or business. These are deemed to arise on the last day of the tax year in which they are generated for purposes of determining the 180-day clock. What's left unclear is how to apply these rules at the partnership level. Could the partnership elect to defer? It's questionable. The partners themselves should be the case. It would be consistent with the rules and purpose of them. The gains that qualify for deferral do not include gains on sales of property to the QOF itself, although the property that is transferred may be qualifying. Gains on sales to related parties don't qualify for QOZ deferral, and neither does 1245 gains, depreciation recapture under 1245. So the second big incentive from the QOZ regime would be the partial forgiveness of your QOZ deferral gains. So after 5 or 7 years, you are entitled to exclude from gross income 10 or 15% respectively of your QOZ deferral gains. We can call this QOZ deferral gain partial exclusion. Given that there's that 2027 clock out there and the 7-year holding period, this effectively means that to get the benefit of 15% exclusion, the QOF interest has to be acquired by the end of 2019. So the last big incentive would be complete forgiveness of post-acquisition gains in your QOF interest. So the idea is that you can exclude from gross income the appreciation value of your QOF interests that are held for at least 10 years through December 31, 2047. So this 10-year holding period exclusion applies to gains from a taxpayer selling interest in a QOF partnership or a QOF structured as an S corporation. The second proposed regulations that were issued in April clarify that the exclusion applies to capital gains from the disposition of QOZ property held by a QOF partnership or QOF S corporation. And we'll define QOZ property here in a little bit, so long as the capital gains are reported on the K-1. So that means that the QOF holds the QOZ property directly and sells it, those capital gains also qualify for the exclusion. But those proposed regulations are silent on shares from lower tier partnerships, whether those can qualify for the exclusion. So given this silence, it would appear that they're not eligible for exclusion. And this would be the regulation that I mentioned taxpayers are not able to rely on yet prior to finalization. So there's a little bit of structuring considerations here. The proposed regulations allow exclusion effectively for an investor that disposes of its interest in a QOF partnership or in a QOF partnership to avoid recognizing depreciation recapture income, which would be ordinary, and other 751 ordinary income gains that would have been recognized had the QOF disposed of its assets. But that recapture income and other ordinary income items recognized by a QOF partnership that disposes of property, including in lower tier partnerships, are passed through as ordinary income and would not be excluded under the QOF interest gain exclusion.
Okay, so as was just mentioned, the QOZ rules essentially provide a 180-day window for a taxpayer to elect to roll qualified capital gains into a QOF. For this purpose, essentially all taxpayers are eligible to make the election. So the QOF rollover is available for individuals, corporations, or partnerships. In the case of a partnership, the election can be made at the partnership level. And if the partnership decides not to make the election, then each partner can make its own decision with respect to its share of any relevant gain. For an electing partner, the 180-day window can start either on the date the gain is actually generated or at the end of the relevant tax year, So there's some added flexibility there. And again, for 1231 gain, the 180-day window would start at year end, since that is the time when the determination can be made as to whether or not there is 1231 gain for the tax year. All right, here on, we point out that the QOZ rules allow investments to be made in a QOF both out of qualified capital gains within the relevant 180 window or other funds of the taxpayer. So for this purpose, we distinguish between the qualified portion of a QOF investment, which would relate to the qualified capital gain that gets rolled over, and the non-qualified portion, which relates to the additional amount invested by the taxpayer. Now, when a taxpayer makes both a qualified and a non-qualified investment, only the qualified portion will qualify for the benefits of the QOZ rules. And for this reason, separate tracking is required for the qualified and non-qualified portion so that the deferrals and exclusions available under the rules can be applied only to the qualified portion. Now, the second proposed regs provide a number of useful clarifications as to when, as to what can constitute a qualified investment in a QOF. First, a taxpayer can buy a QOF interest from an existing owner, and the amount paid will be considered a qualifying investment. And the amount paid is the amount of cash and the fair market value of any property paid to the seller. Next, the taxpayer can transfer property into a QOF in a non-recognition transaction, such as a contribution to a partnership under Section 721. And in that case, the qualifying investment will equal the lesser of the net fair market value or the net tax basis in the interest that's received after applying relevant carryover basis rules, taking into account any debt that gets transferred as part of the transaction. And then a taxpayer can simply sell property to a QOF in a wholly taxable transaction, and in that case, the fair market value of the property sold will constitute a qualified investment. In this case, however, no QOF benefits will extend to any gain that's generated by the taxpayer on that sale. And then on the other hand, as pointed out here, the proposed regs provide that a partnership interest issued in exchange for services cannot be a qualifying QOF interest. Okay, so based on these rules, we have the concept of a mixed fund investment where a partner can hold both a qualifying interest and a non-qualifying interest in a QOF partnership. In that case, the partners consider to own two separate partner interests, which runs counter to the general Irish approach that there's only a single interest in the partnership for each partner. For example, a capital interest and a profits interest are generally considered one, but not in the case of a QOF. Consistent with this separate partnership interest approach, income loss, other partnership items will need to be allocated between the two partnership interests, generally based upon relative allocation percentages applicable to the two. And where there is a capital interest and a profits interest issued for services, the rules require that the profits interest allocation be based on the highest percentage that would be allocated to the profits interest essentially during the life of the partnership. Commentators had obviously requested other approaches because the one adopted by the regulations is not particularly helpful to taxpayers. Here we just consider distributions by a mixed fund investment and ask whether a taxpayer could elect to allocate the distribution solely to the non-qualifying investment, which would allow the taxpayer to preserve QOZ deferral and exclusion benefits with respect to the qualified portion. And the answer under the proposed regulations is no. Instead, distributions are allocated ratably consistent with the way partnership items are allocated between the two separate partnership interests. Certainly from a policy perspective, I think arguments could be made for other approaches that would allow QOF benefits to continue for longer, and commentators have certainly made that point. Just a quick note here that as a starting point, the disguised sale rules under 707 would apply to transfers of property to a QOF if there is a distribution that follows within a relevant period of time so as to justify recharacterization of the transaction as a taxable sale. And the regulations go a step further and provide a modified disguised sale rule or even a cash contribution to a partnership could result in disguised sale treatment if there is a contemporaneous distribution to the partner. And the rules, the regs achieve that by treating the contribution of cash essentially the same as if property were contributed to the partnership and then analyzed under the disguised sale rules. Relevant to that is expressly excluded is the exception of the disguised sale rules for leveraged distributions, and there is an example in the regulations that contemplates a contribution of cash and followed it sometime thereafter by a leveraged distribution by the partnership, and the result is that results in a deemed disguised sale and a non-qualifying investment in the QOF. All right, now we will review the requirements that must be met in order to be a good QOF. And the first requirement here would be an assets test, under which at least 90% of the fund's assets must consist of, quote-unquote, QOZ property. And we'll discuss later exactly what would be considered QOZ property. Notably, for this purpose, the regulations permit a sale of QOZ property and a reinvestment into what also would qualify as QOZ property, as long as two requirements are met. The reinvestment must happen within a 12-month period, and in the interim, the sales proceeds must be held only in cash equivalents, or short-term debt instruments with maturity of 18 months or less. In determining whether the 90% threshold is met for a tax year, the rules look to the average of the QOF's assets as of the last day of the first 6-month period of the tax year, and then the last day of the tax year. And we just note here that the rules allow recent investments within the prior 6 months to be excluded from the calculation. Unclear, however, whether it should be excluded from both numerator and denominator or included in both. I think probably tend towards the former. All right, this slide just shows some rules relating to the starting date for the first 6-month period of a QOF. As a general rule, the first 6-month period begins on the first day of the month for which the QOF election is made. So basically the QOF election can be made for any taxable year after 2017, even if the QOF existed prior to the year of election. And then, I guess significantly, the QOF can select any month within that tax year to start the clock on the asset test. So there then are opportunities to plan around the asset test in cases where the QOF is ramping up its qualifying investments during a year. And here we contrast alternatives where a QOF might choose to defer its election until April of the tax year, and then the relevant test dates would be September 30th and year-end 12/31, or perhaps the QOF would wait to make the election until at least July, in which case there would only be a single testing date, and that would be at year-end. We do note here at the end that there is a catch to the overall election timing, and that any investment held by the QOF prior to the first year of its election will not be eligible for the QOZ benefits. All right, valuation. General rule is cost basis, unadjusted for depreciation, et cetera. Or if the QOF does reporting on quote-unquote applicable financial statements for some reason, the QOF can use the value reported on those statements. For this purpose, applicable financial statements is defined by reference to the mark-to-market rules under 475, and generally includes financials filed with the SEC or other regulatory authorities, or that are audited financials provided to creditors or investors, or used for some other significant non-tax purpose. And then, as noted, the IRS has invited comments as to whether adjusted tax basis or some other valuation methodology should be considered in addition to the ones prescribed. Beyond the asset test, there are a handful of other requirements for being a QOF, none of which are particularly troublesome. First, the QOF must be a domestic corporation or partnership, and this would include an LLC that is a corporation or partnership, depending on what check-the-box selection is made. And the purpose of the QOF must be to invest in QOZ property. Do note here that there's a self-certification requirement, which sort of simplifies things. A form, I believe it's 8966, simply gets filed with the IRS, where the electing corporation or partnership with designated status as a QOF and state that it meets the requirements. Now, not surprisingly, the regulations contain a broad, although perhaps standard these days, anti-abuse rule that allows the IRS to recast a transaction where there is considered to be a tax avoidance element, inconsistent with the QOZ rules. There's no examples of the anti-abuse rule provided in the regulations. The preamble, however, does mention mass acquisitions of unimproved land as being something that would be potentially subject to anti-abuse challenge. As a final note here, there's no requirement that the QOF itself be engaged in a trade or business, but that's in contrast to the concept of QOZ business as applied to QOZ property, which will be discussed later.
Okay, now we're going to discuss what exactly is QOZ property. You'll recall that it's relevant because a QOF must meet the 90% assets test, so 90% of its assets must be QOZ property. There are three categories of QOZ property. First is stock acquired solely for cash by the QOF after 12/31/2017 in a domestic corporation that is a QOZ business or is organized for purposes of becoming a QOZ business at the time the stock is acquired. Similar rules apply to domestic partnerships. You can have interest in a partnership acquired solely in exchange for cash by the QOF after 12/31/17. The partnership needs to be domestic, needs to be a QOZ business, or be organized for purposes of becoming a QOZ business at the time that the interests are acquired by the QOF. So it's a snapshot view of the nature of the QOZ stock or the QOZ partnership interest at the time it's acquired by the QOF. One wrinkle with the partnership interest is the proposed rules do allow capital and profits interests to qualify, but there is a requirement that the interest be acquired solely in exchange for cash. So that would exclude profits interest acquired for in whole or in part for services. The final third category of QOZ property is QOZ business property that is held directly by a QOF. The QOZ Business Property is defined later on in this presentation. It is, of course, a narrower term than QOZ Property. It is one category of QOZ Property. During 90% of the QOF's holding period for QOZ stock or QOZ partnership interests, the relevant corporation or partnership, which we call a QOZ portfolio company, must continue to qualify as a QOZ business. The statute provides that substantially all of the QOF's holding period, the portfolio company must continue to qualify as a QOZ business. The proposed rules is define that as a 90% threshold. What they have not clarified is how the test is applied, whether it is applied on an annual basis, like the 90% assets test, or whether it's a cumulative test that looks back at the holding period for the duration of the holding period. For example, what if the test is not met in the first year of formation, but is met each of the next 10 years thereafter before the investment is disposed of? Would that be 90% of the QOF's holding period? A QOZ business must meet all of the following requirements, and there are a lot. Going to be a few slides on this. First, it must be a trade or business. At least 50% of its gross income is from the active conduct of a trade or business in a QOZ. In many cases, the source or location of gross income may not be clear, but the second proposed regulations provide 3 safe harbors for meeting this requirement, in addition to a general facts and circumstances analysis. Third, a substantial portion, which the regs define as at least 40%, of its intangible property must be used in the active conduct of a trade or business in a QOZ. And there is no current clear guidance as to where intangible property is used. So it's not clear how to determine whether intangible property is being used in a QOZ in an active trade or business. Fourth, the QOZ business must not be engaged in certain listed leisure activities that are laid out in the statute. Next, a QOZ business on no more than 5% of the average unadjusted basis of its assets may consist of, quote, non-qualified financial property, such as cash and short-term debt. Thankfully, there's a safe harbor for reasonable working capital, but it has some limitations. The working capital assets must be designated in writing for the development of a trade or business in a QOZ, as well as acquisition, construction, or substantial improvement of tangible property in a QOZ. There must be a written schedule for the expenditure of the working capital assets that reflects the expenditure of those working capital assets within 31 months after the capital has been received by the QOZ business. A couple points. Exceeding the 31-month time frame may be allowed if the delay is attributable to government delays. And a QOZ portfolio company may get a new 31-month period for each follow-on investment that applies only to the working capital received in that investment. So it can be staggered in that way. The working capital assets must be used in a manner consistent with the designation and schedule above. So you got to stick to that plan in a manner that's consistent with the plan. And finally, note that a QOZ portfolio company is allowed this working capital safe harbor, but a QOF is not. But a QOF can apply the 6-month rule discussed previously that ignores recent cash contributions in the last 6 months, whereas a QOZ portfolio company cannot ignore recent cash contributions.
David, I think, one point to note, I think, with the combination of the 6-month rule that allows a QOF to hold capital, and then the 31-month rule that allows a QOZ portfolio company that is owned by the QOF to hold working capital, in many cases may allow investors who want to defer and roll over capital gains the ability to go ahead and defer and roll them over prior to the end of this year, and then effectively park the cash in a QOF for up to 6 months, and then have the cash contributed to a QOZ portfolio company where it stays for up to 31 months. And all of that works so long as there's a plan to use that cash down at the QOZ portfolio company to develop or develop a business, construct assets, et cetera, and then these other requirements on this slide are met. So it's a pretty good planning opportunity.
That's a good point, Steve. Yeah, you have to pull out your calendar and your timeline and pay close attention, but there's ways to use this to your benefit. A next requirement for a QOZ business is that substantially all, which is defined as at least 70% in this case, of the tangible property owned or leased by the entity is QOZ Business Property, which we're going to call the 70% assets test. It's unclear how reasonable working capital that qualifies for the safe harbor we just talked about is treated under this assets test. That's a common theme in these rules. Should the QOZ Business Property should it be included as QOZ Business Property in the numerator and denominator? We think that should be the answer. Or should it be ignored from the calculation? Or should the working capital only go in the denominator, which would be a bad answer. As discussed earlier, at least 50% of a QOZ's business gross income must come from the active conduct of a trade or business in the QOZ. And I mentioned there are 3 safe harbor tests to satisfy the sourcing requirement. The first 2 are ways of measuring services performed in a QOZ. Number 1 is an hours test, where if at least 50% of the services performed for a business by its employees and other service providers are performed within the QOZ, then that meets the safe harbor. The second measures services using compensation. So if at least 50% of the compensation for services performed are performed within the QOZ. And the third test, in cases where the 50% services threshold is not met, it's a 2-pronged test where if the business's tangible property located in the QOZ and the management or operational functions performed in the QOZ are each necessary to generate at least 50% of the gross income of the trade or business. The second proposed regulations provide that leasing of real property can be the active conduct of a trade or business, but just entering into a triple net lease or holding land for investment will not satisfy this requirement. One question is whether a QOF itself, which does not have this active trade or business requirement, can do triple net leases. So a QOF isn't technically required to be engaged in a QOZ business. A QOF can meet its assets test by owning QOZ Business Property, and the QOZ Business Property, as we're going to talk about, does not appear to have an active trade or business requirement.
All right, we previously discussed that QOF itself has to meet this 90% asset test. And that test can be met by owning up to 90% of its tangible assets through QOZ Business Property or interest in a QOZ portfolio company. Similarly, if the QOF owns a QOZ portfolio company, the QOZ portfolio company has to meet an assets test. As we discussed earlier, at least 70% of the portfolio company's assets have to consist of QOZ Business Property. So the QOZ Business Property definition becomes a pretty important definition for purposes of qualification of the QOF. There are multiple number of requirements that need to be met in order for property that's owned to be QOZ Business Property. First of all, the property has to be tangible property used in a trade or business within the meaning of U.S. federal income tax law. The regs say trade or business. They don't specifically say active trade or business. So query whether simply leasing, in this case, net leasing, would actually be okay up at the QOF level if a QOF is relying on ownership of QOZ Business Property. This requirement also doesn't specify any particular absolute minimum of QOZ Business Property that needs to be owned. It simply says that at least 90% of or 70% of your tangible property has to be QOZ Business Property, but if you have a very small amount of tangible property that is part of the business, as long as you meet the 70 or 90% test, there doesn't seem to be any minimum amount of tangible property that needs to be business property. Second requirement is during 90% of the QOF's holding period or the QOZ portfolio company's holding period for the property, at least 70% of the use of the property must be inside of the QOZ. That particular requirement, it's pretty ill-defined as to, there's virtually no guidance as to what that means. Obviously, if you're talking about real property, you don't need a whole lot of guidance there since real property doesn't move around. It'll be either within or without the QOZ. If you're talking about personal property, this becomes a little difficult to apply. The third requirement is that the QOZ Business Property, or the property in order to qualify, has to be acquired by purchase from an unrelated party. For purposes of this rule, related party is defined by reference to a greater than 20% ownership type of relationship. Two prongs to that test. One is that a party that owns more than 20% of QOF or QOZ portfolio company, either directly or indirectly, would be a related party. Also, a party that commonly owns interests in both the QOF or QOZ portfolio company on the one hand, and then the seller of the property on the other hand, would also be a related party if those common owners own more than 20% of both the QOF/QOZ portfolio company and more than 20% of the seller. In the case of partnerships or LLCs taxed as partnerships, that 20% test is measured by reference to the person's ownership in either capital or profits of the partnership or LLC. So what that means is that you could have just a, say, 15% capital interest, but if the seller of the property also has a carried interest or profits interest that pushes its overall interest in profits up above 20%, that would cause the seller to become a related party. There's some intricate analysis that sometimes needs to be undertaken to make sure that that's not the case if you're talking about someone who has a profits interest or a carried interest. In addition, as I mentioned a minute ago, the second requirement is that or sub-requirement, is that the property has to be acquired by purchase. What that generally means is that there has to be a taxable sale of the property to the QOF or QOZ. The property cannot have been acquired in a non-taxable transaction. This takes away a pretty common type of transaction in which a property owner contributes property to a venture, other parties contribute cash. The property owner hopes to get tax-free treatment on that contribution. Well, that won't qualify as QOZ business property because if the property is contributed to a QOF or QOZ portfolio company, it will not have acquired that property by purchase. Fourth requirement in order to be qualifying QOZ Business Property, the original use of the property in the QOZ must be with the QOF or the QOZ Portfolio Company, or if the original use requirement's not met, the QOF or QOZ Portfolio Company has to substantially improve the property. So either original use or substantial improvement, one or the other. Substantial improvement generally means that the QOF or QOZ Portfolio Company has to make capital expenditures with respect to the acquired property that at least equal or exceed the price at which the QOF or QOZ Portfolio Company originally acquires the property. So if the acquisition of a piece of existing property is at, say, $5 million, then at least $5 million or more has to be spent substantially improving the property. For purposes of determining whether you meet this substantial improvement threshold, the regulations say you have to measure that on an asset-by-asset basis. So, for example, if as part of one transaction you acquire two buildings from the same seller and you pay $10 million for both buildings, and one of them needs to be substantially improved, the other doesn't. You got to first bifurcate the purchase price between the two buildings, and then you have to spend at least as much substantially improving the individual building as that purchase price that's been allocated to it. And what that also means is that if you spend, let's say you spend $10 million and you only improve one of the two buildings, and you spend $20 million improving that one building, only that one building is going to qualify. The first one doesn't qualify because you haven't substantially improved it, and the test is on an asset-by-asset basis. That particular requirement, there's been a lot of criticism of it. There's been a lot of comment letters recommending that there be some aggregation, and in particular, contiguous tracts acquired in a single transaction or series of related transactions that themselves are kind of serve the same functions, same business, part of the same business. Seems like those ought to be aggregated, and there's been significant sets of comments to the IRS requesting that ultimately, and may be the outcome, but currently the regs don't provide for it. Okay, in the case of land or real property, substantial improvement rules have been somewhat liberalized by the second set of proposed regulations. If you buy land and it's raw land, there really isn't any substantial improvement requirement with respect to the raw land. The only requirement is that you have to hold that land to be used in a trade or business. In other words, you can't simply hold it for investment purposes with a view that you're going to hold it for some period of time and resell it. You really have to have some expectation that you're going to develop the land and or otherwise use it in a trade or business. Additionally, if the land already has some sort of structure on it, some improvement, when you're measuring whether you substantially improve that piece of real property, the test is only by reference to the piece of the purchase price that relates to the building or improvement. You don't need to look at how much you paid for the land. That makes purchase price allocations between land and building pretty important. For example, if you spend $10 million on a piece of real property and only $2 million is really allocable to the building because the building needs significant improvement, well, you don't need to spend at least 10 to meet this test. You just need to spend at least $2 million, which is equal to the amount that you paid for the building. In other words, you get to exclude the land from the test altogether. There is kind of one interesting conundrum. If under that example, if you maybe a little different example. If you did purchase something for $9 million, real property, and you allocated $3 million to the building, $6 million to the land, and you only make $2 million of improvements to the building, pretty clear that the building doesn't qualify as being substantially improved. Query, though, whether the $6 million you allocated to the land actually does count as good QOZ business property. And query whether the $2 million of improvements themselves qualify. I think the answer probably is that the land qualifies and that the improvements themselves don't. And that answer is kind of based on the rule that says you test substantial improvement on an asset-by-asset basis, and looks the land is considered a separate asset. The improvements probably are not a separate asset from the building, the original building itself. Okay, I mentioned you can meet this last requirement either through substantial improvement or original use. Original use generally means that you had to have been the first person to acquire the property in the QOZ, which generally means new property. There is a little bit of flexibility there, though, because the rules actually define original use with a little more flexibility than you had to have purchased the property new. Instead, they look at are you the first person to place the property in service in the QOZ for depreciation purposes. So you can actually buy property that hasn't yet been placed in service, and that'll qualify as original use as to the purchasing QOF or QOZ portfolio company. Another exception is if property was originally used in the QOF or QOZ, then the property is vacant for at least 5 years, and then the property is put back into service after it's acquired by the QOF or QOZ portfolio company. That should qualify. Finally, the last topic under the QOZ Business Property rules relates to lease property. Lease property, the latest proposed regs provide for a lot of flexibility for leased property that isn't available for purchased property. In particular, there is no requirement that leased property meet an original use or substantial improvement requirement, so that the QOF lessee or the QOZ portfolio company lessee can use leased property that's previously been used in the QOZ by the lessor, and it need not substantially improve that leased property. The requirements for leases to qualify as good QOZ business property, well, the lease has to be on an arm's length basis with arm's length terms. Proposed regulations refer you to the Section 482 rules relating to what constitutes arm's length transactions between related parties. However, as most people know, tax practitioners know who have used those, worked through those rules, there isn't a whole lot of clarity as to when something's considered really a market rate, especially when you're talking about something like a lease that in a QOZ that you could probably look to third-party leases and there'd be varying terms, rates, and offsets. So that's probably an issue that there requires a fair bit of analysis to make sure you're comfortable that you have an arm's length lease. There's additional requirements if the lessor is related to the QOF or QOZ business. Basically, the QOF or QOZ portfolio company lessee can't prepay significant amounts of the rent. Significant is more than 12 months of prepayments. The other rules or restrictions relate to lease tangible personal property. If the lessor and lessee are related and the lease is of tangible personal property, there are some other technical rules that require the QOF or QOZ portfolio company to make acquisitions of other qualifying QOZ business property within a certain period of time, and those rules are outlined on the bottom of the slide. one of the rules that I think gives pretty good flexibility or provides the flexibility under this rule is this rule appears to permit ground leases of land. What the flexibility that allows for, I think, is that if you do have someone who owns land and they're either a related party or someone who otherwise doesn't want to make a taxable sale of that land, they could ground lease the land to a QOF or QOZ portfolio company who could then develop the land. In cases where the QOF or QOZ portfolio company is a lessee, you have to figure out, okay, what is the value of that lease, or what's the amount of that lease that is taken into account under the 70% asset test for the portfolio company or the 90% asset test for the QOF. There are rules that basically tell you that if you have an applicable financial statement, as Don mentioned earlier, which would be something that's filed with the SEC or governmental agencies or audited financials that are provided to creditors, and you have a valuation of the lease on your financial statement, you would use that value. If you don't have a valuation on your financial statement, you look at the sum of the present values of the rental payments due under the lease, discounted back at AFR. Obviously, that results in a long-term lease resulting in a pretty large amount of qualifying business property potentially for purposes of those asset tests. Okay, I'm going to shift gears now to inclusion events. Inclusion events, earlier we mentioned that general rule is capital gain that's deferred can be deferred up until 12/31/26. However, the gain recognition is accelerated if there is an inclusion event. Generally, inclusion events include any transfers of QOF interests by a holder of the interest. The transfer reduces the holder's equity interest in the QOF. Also, if the QOF is actually terminated or liquidated or deemed terminated or liquidated, certain distributions from a QOF are also inclusion events, and these are just kind of the general rules. However, there's a whole host of specific examples in the regulations that are not inclusion events. One of the big ones I think that I see most frequently is that a QOF partnership can actually make distributions to holders. Generally, that's not an inclusion event unless the cash or property received by the holder, and property is based on the fair value of the property, exceeds the holder's tax basis in its QOF interest. That can generally allows for most distributions to escape being treated as inclusion events. This slide lists a whole host of other specific rules. Next slide, whole host other rules that indicate what isn't an inclusion event specifically. The regulations have some detailed rules. Maybe the most important of which that I run into is that tax-free contributions of QOF interests to other partnerships are not inclusion events. Similarly, partnership mergers are not inclusion events. Conversely, a tax-free contribution to a C Corp, Section 351 contribution, is an inclusion event.
Some additional considerations for QOF partnerships, as Steve just mentioned, distributions of cash distributions of cash are an inclusion event to the extent they exceed the partner's basis in the QOF interest. Because a partner's basis includes its share of allocable debt, you can have a debt finance distribution, but beware of the application of the disguised sale rules that we discussed earlier. If that distribution occurs within 2 years of acquiring the interest. For S corporations, some additional thoughts. Converting the S corporation to a partnership or a disregarded entity will be an inclusion event unless the conversion qualifies under Section 381, and terminating the S corporation status is not an inclusion event. we discuss on this slide what happens if you have an inclusion event, how much gain you have to recognize, and the effect of an inclusion event on the basis of a partner's interest in the QOF partnership or QOF generally starts out at 0, increases by 10 or 5% once you meet that 5 and 7 year holding period requirements. And then you increase the basis for your QOZ deferred exclusion or deferred gain exclusion immediately before disposing of the interest. And upon disposition of the QOF interest, the basis of the partnership assets, including the hot assets, are adjusted immediately prior to the disposition. That prevents that hot asset gain and a corresponding capital loss. And as I mentioned earlier, that those same rules don't apply for lower tier partnerships. So there's some planning considerations to be thinking about.
Good. Here, I think we just do a quick compare and contrast of the new benefits of the new QOZ rules to the longstanding benefits that are available under 1031 for like-kind exchanges. And won't go through the entire list here, but I guess just in a sense to summarize, after tax reform, like-kind exchange treatment is generally only available for sales of real estate and would require all of the proceeds of a real estate disposition to be reinvested in new real estate, and in that case, there would be the opportunity for tax deferral on an indefinite basis, whereas under the QOZ rules, any capital gain is eligible for potential deferral, albeit for a limited period of time. But unlike the 1031 rules, there's also the possibility for exclusions of some part of the original gain that's recognized and potentially all of the appreciation that's generated in the succeeding QOF investment.
Okay, and we have a few slides that discuss issues of particular interest to technology ventures. Primarily on this slide, a technology venture would tend to have a large amount of intangible property, and the fact that it's unclear how to determine where intangible property is used would be a big question for technology companies, as they have to meet that 40% test. One point to note is the 40% threshold for QOZ portfolio companies allows valuable intangibles to be held directly by a QOZ business, whereas a QOF is much more limited in the intangibles it can hold, limited to 10% intangibles in cash. There's a possibility for structuring to separate a business into parts in order to qualify perhaps one part of the business as for QOZ benefits. And that requires some close analysis to get it right, but there's an example there on that slide. And again, there are issues we've already brought up regarding the timeline for investment. We were talking about how you need to carefully plan your cash contributions to the QOF and then down to the QOZ portfolio company. And these issues are front and center with startups, especially, which tend to burn a lot of cash in the early years. So some thought has to be given to how to plan to spend that cash and to make sure you're meeting the assets tests and the holding period requirements.
Yeah. Finally, we're just about out of time, so I won't go through this slide, but I think that QOF benefits have a lot of potential applicability to oil and gas activities, whether they be E&P / upstream, midstream, or downstream. You know, I've given a couple of examples on this slide, as well as a few issues to look at. since we're out of time, I won't go through the slide, but certainly if there are any follow-up questions on any of the slides, anything that we covered, we're happy to answer those via email. On the first page where our bios are located, each of our email addresses are listed. So please do feel free to send any one of us any follow-up questions you might have. And thank you for listening in and being a part of our webcast today.